But I think like 8 to 10K is very reasonable in the next 3 to 5 years on gold. I still think silver's going to 60 to 62, probably early next year. And then beyond that, the sky's the limit.
Almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice.
In a recent discussion, Andy Schectman and Gareth Soloway shared their insights on where the precious metals market could be heading next. With gold showing remarkable strength through economic turbulence, both experts see the next 3 to 5 years as a major turning point. Gold, they suggest, could reasonably reach between $8,000 and $10,000, not through hype, but as a natural outcome of debt-driven policies, central bank accumulation, and the global shift away from fiat trust. Silver, meanwhile, could be preparing for an explosive breakout of its own. Forecasts point towards $60 to $62 in the near term, possibly as early as next year. Recent data backs this up. Almost 39 million ounces of silver have been delivered to the COMEX, nearly triple the usual figure. That shows serious investors are no longer content with paper claims. They want real, physical metal in their hands. This rising demand signals a deeper change in how the world values money and tangible assets. The era of undervaluing gold and silver may be drawing to a close. Don't forget to like, share, and subscribe for more expert financial insights and market updates.
Let's go back to the 1979s. Where did gold pull back to when it had its first major bounce, right? And the answer is, if we look at this, look at the high of that push up where we consolidated. And if we draw a trend line there, that's virtually where we pulled back to before we actually got our first major bounce in gold. Well, what does that mean? Well, if we pull back in that same manner in 2025, that would bring us down to about that 3,500 level, which if we flip to this other chart, that's my max drawdown level. And so ultimately, while the correction is likely going to be a little bit painful for people that bought at 4,000 or above, I think, again, if you're someone with a longer term view, the differences in the government spending, the debt the U.S. has, debt to GDP, and interest rates, that tells you buy like crazy when it gets down to these levels. And when you look at 1979 and mirror that with 2025. And just to take a look at this, we had the same run up early here in 1979. We had the same run up here in 2025. Then we went into this base of consolidation, and then literally 9 straight up weeks in a row in 1979 led to this big correction. And sure enough, 9 straight up weeks, and we're correcting as well. And a lot of people say to me, and this is a valid point, is that, this isn't the same, right? We have a very different scenario. It's true, and we're going to go over that in a second, but I think it's important to recognize that fear and greed are the same, right? And so while in 1970, Volcker was raising interest rates in the 80s, right? He raised it 15, 16, 17, 18%. Here we have the Fed lowering rates. We also had only 32% debt to GDP in 1979, 1980. We have 130% now. And so things are very different, but human psychology doesn't change. Now, how does the difference play out? The difference maker is in 1979, when we topped out, it literally took almost 30 years for gold to make a new all-time high. I think we make a new all-time high within 6 to 12 months, but the correction still needs to happen.
I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice. But what we have been seeing is deliveries like in gold that are 93% higher for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the commitment of traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period. And so, in essence, what we saw in my mind last week was driving down the paper price and immediately delivering contracts for the current month. They would drive down the December paper price, the futures, and stand for delivery and an immediate contract in October. So what was interesting to me about it as well was some of the, I think it's Michael Lynch, I think is his name. I'm pretty sure. Sorry, Michael, if I got that wrong, but I think that's who it is. And he writes a report dealing with COMEX, and he talked about the footprints that he saw, that the two entities that, first of all, on I want to say Wednesday or Thursday night, the price was driven down after New York had closed. And it was driven down in between New York and China, Asia, where there's virtually no liquidity, where no rational trader would ever dump metal, copious amounts all at once into a very thinly traded illiquid market.
You just have global central banks buying gold. We have governments that are just taking on more and more debt. And it just leads you in one direction, which is precious metals or potentially Bitcoin longer term. I think overall you have to be thinking 5K is the next big threshold, right? Human nature, psychology, which is a big part of investing and trading, it's always attracted to these bigger numbers. And obviously we got up to about 4,400 or so. Now we're correcting. I think the next push takes out those all-time highs, tags 5,000. I don't even think that's the end of the bull run. I think this could be a multi-year move, but that would be where I would say, okay, once we achieve that, let me just, again, take a pause. Let me analyze the charts. Do we see a pullback at that point before we continue much, much higher?
In a detailed market analysis, Gareth Soloway drew fascinating parallels between the current gold market and the late 1970s bull run. Back then, gold experienced an incredible surge before a healthy correction set the stage for another powerful move higher. If history rhymes, a similar pullback in 2025 could bring gold down to around the $3,500 level. A level long-term investors might see as a massive buying opportunity. Unlike the 1970s, today's environment includes far higher debt-to-GDP ratios, central banks aggressively purchasing gold, and governments increasingly burdened by unsustainable spending. These differences suggest that any correction now could be shorter and followed by quicker new highs, potentially toward the $5,000 mark. Recent COMEX data supports the growing physical demand narrative, with record-breaking delivery requests and immediate contract settlements, signaling that investors are seeking real metal, not paper promises. Despite short-term volatility, the structural foundation for gold's next leg higher remains intact. As psychology, debt, and liquidity pressures converge, the coming months could redefine the precious metals landscape entirely. Let's get into the interview.
This is a deal where, at the same time, you have one of the largest short positions ever on SLV. Over 80 million shares are naked short to affect this. There's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever. And at the same time, it's getting hammered. And SLV has an 84 million ounce short position or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So I guess it's shares. So the shares are being driven down, which affects the price. But yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But, when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the COMEX. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. And, again, think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable.
But right. Bitcoin is still struggling. Now, Bitcoin has rallied up here, But again, it's still stuck below this upper trend line. And you can see here, this is an amazing trend line. Again, we talk about the random moves on Bitcoin and how parabolic it's gotten. But look at this. We have a trend line that starts at the bull market high of 2017, connects through this high in 2021's bull market, and it's literally stopped Bitcoin in its track 3 consecutive times across here. And so for me as a technician, I pay attention to this because what I look at it and I say, unless this level gets taken out, there's a cap on Bitcoin in terms of upside. Now, listen, we could break through this, and then once we do, it's off to the races. But until that happens, I must respect the $126,000 to $127,000 level. And just flipping back to this daily chart, we have the daily moving up, which is great. But why is Bitcoin still about 10% off of its all-time highs when the equity markets are keep on, higher and higher? And it does concern me a little bit. We've seen Bitcoin correct. We've seen gold correct. The equity markets are the last thing. And I do worry it's, again, the Bitcoin. Bitcoin historically has been a little bit of a leading indicator for the equity market. So while Bitcoin's doing well these last couple days, I'm not 100% sold yet that it's going to get back to that trend line. And I do worry what it says for the equity markets.
In today's turbulent markets, the battle between paper trading and physical demand has never been clearer. Silver's market is under immense pressure, with reports showing one of the largest short positions ever on SLV. Over 80 million shares shorted, representing nearly 15% of total shares outstanding. While paper prices are being driven down, physical delivery requests in both gold and silver continue to surge, signaling that investors are quietly moving toward tangible assets rather than digital promises. Meanwhile, Bitcoin presents its own puzzle. Despite a series of bullish moves, the cryptocurrency remains capped below a powerful multi-year trend line near $126,000, $127,000. Until that level breaks decisively, upside potential remains limited. What's more, Bitcoin's struggle to reclaim its highs, even as equities rally, could be a warning sign for broader markets. As massive liquidity injections continue and central banks maintain their quiet gold accumulation, the disconnect between real value and speculative trading widens. Whether it's precious metals or digital assets, investors are being reminded that momentum can shift quickly, and only those who stay informed will navigate it wisely. Don't forget to like, subscribe, and comment below with your thoughts on where gold, silver, and Bitcoin are headed next.